abstract asset management, and give you guys kind of where we see the real risks in the marketplace. This one is going to sum up some of 2013 and go into where we see some of the major risks in 2014 and some of the things that we're going to do about it, and really just shed some light on some data and research that we've been doing. Then we're going to kind of transition over and have Rocket, our head portfolio trader with TAM Portfolios, talk about our portfolios, how we're positioned to take advantage of a potential run, consolidation, or obviously a correction, and kind of what we're going to do about it. Looking to do these on a monthly basis. We're open to feedback, so as you guys go through this, do us a favor. If you think of ways that we can help make this more relevant to you and more productive, don't be afraid to let us know. You can always type that type of stuff in the chat section. Just a quick note on some housekeeping things. Any questions that anybody has, you can type in the chat section. We'll hopefully be able to get to them. If we don't have time to get to all of them, you can feel free to call us, shoot us an email afterwards. We're more than happy to get those answered. If you could try to hold some of those questions to the end, or at least when we go through some of the transition points, that would be best. We will have a live Q&A session towards the end of the webinar. So with that said, we'll get started. And before we get going, it just wouldn't be right if I didn't have a plug in today's day and age, which we're actually very, very excited about. Kevin, he's finally, after 10 years of work, has published his theory for the third or fourth time, in book format though for the first time. It's available on Amazon.com, Barnes & Noble, CreateSpace, and really it's our philosophy. It talks about an evolutionary perspective of investment risk, how the market has changed, the cycles, explaining the cycles going back to 1900, and really kind of getting a whole kind of all-encompassing view from fundamental valuation, technical analysis, behavioral finance, and wrapping that all up with a quantitative view, and being able to really look and ascertain the risk levels in the marketplace on a cyclical kind of business cycle, and then also from a macro secular viewpoint. So that book is available, and we will also be at the TD Ameritrade conference here in Orlando in January, towards the end of this month. We're going to be there at booth 101. We're going to be actually giving out free signed copies of the book. Kev's going to be there giving his John Hancock on there, and if you guys are going to be at that conference, feel free to stop by and look us up. And also one of the more exciting things for us in the developments on a business development side, we've just worked and finished up the paperwork and getting set up on the PlaceMark Investments platform. It's a new UMA. Well, new is probably the wrong word. They've been around for quite some time, but it's really starting to get some ground. It's a UMA marketplace at PlaceMark Investment, and of course you can always find us on Charles Schwab. So we're very, very excited about that, and I won't take any more of your guys' time. I'm gonna turn this over to Kevin right now. So Kevin, go ahead.
Great, thank you. Let me go ahead and show my screen. I appreciate all the kudos, and hopefully the book will be a great success and help a lot of advisors and individual clients out there understand some of the philosophy not only that we use here at the firm, but some of the philosophies that we believe were laden into the atypical mainstream asset allocation challenges that people have been going through over the last decade plus, obviously since the turn of the millennium. But to walk through what we're going to do today, and you see the agenda in front of you, is I'm going to give a synopsis on a little bit of what we've discussed in our deliverables, whether it be our Morning Cup of Joe that comes out weekly, and we also have a monthly edition that comes out, and also our quarterly reports, which has happened through 2013. I'm going to talk about our fusion analysis, which separates down to the fundamentals, behavioral, and technicals, and then we're going to turn it over to Josh Wells, lovingly called Rocket here, who is our portfolio manager at TAM Portfolios, and then we'll have a summation and a Q&A. So really, I have a lot of information to go through, and I'm going to do it relatively quickly. I'm also going to do it with a lot of graphs, so you're not going to see anything on verbiage, so you don't have to read the presentation. I'm just going to walk through it. A lot of people, obviously, you go into these webinars and you end up having to read what the person's talking about. So we're just going to walk through it. And again, as Josh was mentioning, if you have any questions, I really want to be able to answer them for you, because a lot of this information that we're going to bring out today has we've opined on a lot of the past documents. So I hope that I won't skip over too much information, but there's going to be some things in here that we've talked about in the past that I'm going to regurgitate and also mention how it's changed going forward from 2013 into 2014. So before we really go down all those paths, I want to say that we're going to begin by breaking down the fundamentals and understanding where the market is. And the market has changed dramatically from the beginning of 2013 to the end of 2013. And as Fusion analysts, we do look at, obviously, the fundamentals, also the behavioral finance aspect of the market, and then also the third tier would be the technicals. And we add those all together in our quantitative metrics to come out with what we believe to be the best way to analyze where the market's at. And one of the things that we talked about in the past is the neoclassical economic cycle, and that you can pull up in our last quarterly. That neoclassical economic cycle really is, bring it down to earth, is the law of supply and demand. And the law of supply and demand in our minds, or at least in my mind, breaks down and looks at where that law of supply and demand is coming from. And the first thing that we look at, and what we've talked about all year, is consumer sentiment. And the graph that you see up in front of you shows in the year 2000, where you can see where the graph begins, where it's peak on both the S&P 500 and consumer sentiment. And then you can see over the last decade plus, or in the last 13 years, you've seen a substantial drop in consumer sentiment, and you've seen a run-up or a divergence in the S&P 500. And we've been talking about that for quite some time. So you can see the peak in 07, and then you see, obviously, now where the market is in relation to sentiment. And if sentiment should be driving the market, then why are we having this divergence? So when we talk about a fundamental shift, the second quarter report went through, or I'm sorry, the third quarter report went through and talked about the cracks in the landscape on the fundamental basis. But right now what we're watching is a shift in the fundamentals, and you're starting to see them come up and look a little bit more positive. So this is a good thing for the market, and we'll digress and go into it, but one is sentiment. And if sentiment picks up, that should bode well for spending. So you can see if it breaks through the 82.5 or breaks up through that 80 level, this will be a long-term positive on a macro point of view, 30,000 point view for the marketplace. Next, when we look at this should placate right into retail sales. And this was also talked about in the past, and we talked about how retail sales, by watching it, the retail sales, if it was to break that 2.5% recession warning line, it would be an indication that the market would be in trouble, and we were very, very close to it going midway through the year. Yet, with sentiment picking up, you also saw that retail sales picked up, and we had some substantial numbers coming in November and also in December, again, boding well for the consumer. So going forward, walking down that path, this should also lend us into GDP, and here we go. When you look at a compounded annual rate of change on GDP, we came in 2000, at the end of 2013, Q3 came in at 4.13%, again bouncing off of that zero line, which we were getting very, very close to, and a lot of warning signs on the fundamental were coming up in our aspect. Nothing triggered, but yet we were being very, very cautious on the fundamental basis. So when you talk about all that, the last and final thing is, if you feed this down the economic path, that you should look at unemployment, because obviously as you feed the system, unemployment should be up. Or I'm sorry, unemployment should be going down, employment should be up. So you should watch corporations hire as GDP goes up. Well, in that, the Fed's initial target, as you can see here, showed it was going to 6% before they started the tapering. Then it came out and said, well, we're not really going to focus on that 6%, and we could eventually start tapering, which obviously we've all seen. And now you've seen it, though, it's still declining, which is good news at 7. However, there's another factor that we haven't taken place, and that is the labor force participation rate, which you see on the bottom graph. What this shows, and not to confuse the issue, but essentially the participation rate is calculated by looking at the entire labor force, and that's all the people available to work. And what it does is it measures the people that are actually interested in working or are working. So I don't want to confuse that with unemployment. And typically during a recessionary period, you always see a decline in this participation rate. And then as the growth area picks up, you see a flattening out or an increasing, and then a recession and decline again. However, since the last recession, this slope has been continued down. There's a multitude of reasons. You can read some of it in our fourth quarter report, which will be available tomorrow. And as we put that out, we do discuss this in greater detail. But the point I'm going to make on this slide is that even though the unemployment rate is coming down, this is still a weak spot in the economy, and I don't even know if it's really measuring the amount of people unemployed. And again, we address that further. So by summing this up, what we're really looking at this point is how the fundamentals in the marketplace are somewhat strengthening, yet it's still a concern on unemployment. So let's move forward. And moving forward, it's important that we start to look at what's transpired in the market and why it's at where it's at. We have, in a multitude of our documents over the last year, we have put out the Fed's balance sheet in relation to the S&P 500. Now, I don't have that up today for you. We've seen it 1,000 times if you've read any of our documents or have you seen any of our webinars, but essentially what you're looking at here is this is the balance sheet of the Federal Reserve starting in September of 2008, which was at approximately $900 billion. And since that point in time, on that line, you can see now we're at $4 trillion. December 2013 is $3.11 trillion increase, or 345% increase. If I was to actually overlay the S&P 500 on this, there is an 88% correlation to the move in the S&P 500 or the general market to the Fed's balance sheet. Is this a good thing? This is the question. This is what we're here to answer. So we've talked about the fundamentals improving. We've talked about the market in correlation with the Fed's balance sheet, but yet we're here to answer one question, and that is our market stance going to change based on the fact that we're going to taper? Now, if you have an 88% correlation to the amount of money that they're pumping into the system, let's hope that if they stop pumping it in, that correlation diminishes to zero, and the market would continue to go up, self-sustain, be able to work on its own, and not come down every time that a taper stops. So it's going to take a certain amount of information to understand whether or not that's possible, one of which being we've already talked about is the economics, but the second thing is, has the money that's been pumped into the system truly been at work and really helping the market? And for that answer, there's something very important that we have to talk about that we've never talked about before, and this is going to be brand new. So the brand new topic that I want to talk about is velocity, and it's the velocity of money. Now, I personally believe, in my mind, through the year 2014, the hottest topic that will be talked about, no pun intended, is hot money. It's about the velocity of money. So let me briefly tell you what it is. If you don't know, velocity of money takes all the checking deposits and all the cash that is out there, which is M2, and it talks about how fast it's being used. So I'll give you an example. If I'm a worker, I go to the grocery store and I buy something in the grocery store, then that grocery store clerk gets paid, but also the farmer. The farmer gets paid, and he takes that money and goes buy feed, which feeds the chicken he in turn sells. And then the worker at the feed mill gets a paycheck, he goes back to the grocery store. So that would be one cycle of money. Velocity measures that. Now, I know that's a simplistic view, but essentially that's what velocity measures. And what you're looking at right now is a chart from 1960 till today. And this is the velocity of money. And you can see in the great boom in the technology bubble, you can see the velocity was very, very great. Now you're watching the velocity of money being at the lowest level it has ever been since the velocity of money has ever been tracked. Let me restate that. You are watching the lowest amount of velocity of money ever. Now, why is this important? Well, if you have an economy that is stifling or is not getting up on its own, and you have a Fed that is pumping money into a system, but yet that velocity of that money is not doing anything, so what really is happening to the economy? Is the economy truly strengthening? And one way to measure that, the underlying strength of an economy, is watching the velocity of money, and we are on a sheer downfall. So when you look at that and you ask yourself, well, where is all the money gone? You can look at it in two different places. So we talked earlier, 2 slides ago, about the Fed's balance sheet going up $3 trillion, $3.11 trillion. So where's the money? Well, if you look right now, I just pulled this chart the other day, and you can see that I'm measuring here the excess reserves of depository institutions. What does that mean? That means the amount of money above and beyond what the Federal Reserve requires a bank to hold. Okay, so banks are required to hold a certain amount of deposits based on what the Fed sets as a standard. And that zero line has been in place. I know it shows only back to 2000, but that zero line has been there for many, 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 many years. And as notice on August of 2008, where it was at $1.8 billion, then you began the tapering. That $1.8 billion is now $2.4 trillion. So let me explain this. The excess reserves that are sitting in banking institutions equate to $2.4 trillion. So if the Fed has pumped $3.1 trillion into the system and $2.4 trillion is sitting in banks, what do you think the velocity of that money is? Well, the velocity of money sitting in a bank account is zero. It's nothing. So there's one area. The second area is non-financial corporate businesses. And the reason we pull non-financial is because we just talked about banks, and banks are different. So what we want to do now is look at really corporate balance sheets. And what you'll notice is that it averages since the 1990s somewhere in the area of about $180 billion. Has been the average on the balance sheets of major corporations. That's what they need for liquidity. That's what they go up and they either buy their shares back, which we'll talk about in a second, or they will make mergers and acquisitions, or the most important thing, what are they going to do? They're going to expand into R&D, new technologies, new innovations. Now, since the bottom and the Fed started pumping the money into the system, the balance sheets were at $84 billion, which are now at $431 billion. So you have a $350 billion increase of the amount that they are holding in cash on their balance sheet. And again, that cash is doing nothing. If anybody knows anything about Carl Icahn and Apple, I mean, he's fighting for that same thing. Now, I'm not going to dive into financial engineering. We've talked about financial engineering over the last 2 quarters. And again, if anybody wants to know our comments on that, you can pull our old documents. But this placates, I believe this number would be much, much, much larger than a 400% increase or $350 billion if we actually took into consideration the amount of stock buybacks that's happened in corporations in 2013. So that placates into financial engineering, but the point being is that's also the velocity of money being zero, or that velocity of that money dies. So if it gets into the corporate hands, they buy their shares back, it'll never move again. So looking at those two together, this is 11%. The other one was 77%. That's 88% of all monies that was put into the system from all the QEs has been sitting dormant. 88% of all monies put in the system are sitting dormant. Now, is that good? Is that bad? Well, there's 2 ways to look at it, right? 2 sides to every coin. Somewhere in the middle is the truth. Here's the truth of the matter. Why has the market been running? Is the economy where it needs to be? And are people spending money for innovation? So now it takes us into the next leg of our fusion analysis, which takes us into, sorry, I got the wrong slide there. There we go. Behavioral and the psychology behind the marketplace. And what this is, again, is the behavioral aspect is buying begets buying, the herd mentality. So the market now, where we're positioned, has had a herd mentality, which is not based on fundamentals. I mean, there have been some increases in fundamentals, yes, but it's been mainly, and again, my opinion, the market has been up solely based on the amount of money being pumped into the system. It's the feel-good factor. Are there really new innovations that are being created? Now, if I was to get on with the phone with Andrew Musk, who built Tesla, I guess that would be, he would say, yes, there's a lot of innovation being made. However, on the other hand, on the grand scope of things, we have to look at really what's driving this market, and we have to look at the behavioral cycle of the market. And this is how, this graph here is how we measure behavior. And behavior is important because you have to look at pendulum apexes. So if the market isn't driven on that, and now we have, believe it or not, true statement, clients calling saying, hey, by the way, get me in. I don't want to miss out. This thing is going too high. I better catch it before it goes all the way up. It's becoming too easy. Whatever the case may be, we are starting to enter that apex. Now, I'm not saying that everything's coming to an end. What I'm saying is that there are a lot of warning signs out there in the marketplace on a behavioral aspect, and I'm going to show you one. And the first one I'm going to show you is the Investor's Intelligence Sentiment Number. Now, this number is published. Well, it's actually continually published, but I get it once a month. And what we have and what we're looking at right now is sentiment. Again, the herd mentality, the old adage on Wall Street. If everybody's on the same side of the trade, that's probably the wrong place to be. If you do the opposite of what the masses do, you probably win 80% of the time. So I'm going to start at the bottom. What you'll notice is you'll see bulls and bears. Bears in green, bulls in blue. And you can see that they're both spiking up towards the high end, which means that right now everybody is feeling really, really good. You have very little bears and a whole bunch of bulls. Now on the bear side, it's the least amount of bears that you've had in the marketplace since 1987. On the bull side, same thing since 87, but it has hit there a few times in the past through 2000, 2003, 4, so forth and so on. But what is really important is the ratio. So if you look at the bull-to-bear ratio, which is the red line above, this is something that I believe is a better metric to watch. And right now, you have never seen, well, I'll tell you this, I've been doing this for 23 years. I started in 1991. I have never in my career seen the bull-bear ratio be this high. And the last time it was this high, it was right before the crash of 1987, when so many people were bullish about the marketplace. This is higher than it was before the tech bubble. So if you can just imagine that with every taxi cab driver out there telling people what to buy back at that point, why is this level so high right now? Now, we're not here to answer that, but we're here to show you that there are huge warning signs in the behavioral aspect. The next one that I'll show up is also behavioral, and it's volatility. A lot of people watch this, the VIX index. And the VIX, if you look it back through 2001, both on the NASDAQ on the right and both on the S&P on the left, the VIX is typically used on the bearish side, which means if it becomes too bearish, the VIX gets too high. So typically this is used in spiking periods off bottoms, where when you get those spikes, it means a lot more. However, you can also use it to coincide with what I just showed you on the investor sentiment, and it will measure and help measure complacency. And right now, the volatility in the marketplace on a longer period of time is the least that we've seen, at least back since 2006 or 2005. So the complacency is very, very low. Now, this is not a pinpoint. I would not ever placate using this as a, okay, the VIX is changing, go ahead, and the direction of the market is changing. It's one of the tools that you can use to help ascertain other things in the market. So again, that's on the behavioral aspect. So the two things that have shifted and really changed place is in 2013 when we began, the behavioral aspect of the market was fine. There wasn't a big exuberance, but the fundamentals were not doing so well. And now you have the opposite. So the opposite is the behavioral is looking very, very scary. And the fundamentals are starting to improve. Now, I'm not saying that they're going to blast off, but they're starting to improve. Then you overlay on top of that the tapering. So people say, how fast is it going to taper? Okay, that's going to be the question. How fast is it going to taper? Now, there's two arguments to this. Number one, the argument being is they will go ahead and taper, but the money, the velocity of money that is sitting dormant, 88% of the $3.11 trillion that is sitting in banks and on corporate balance sheets will start to be spent and make up the difference of the quantitative easing. Now, is that a benefit? Absolutely, because now you will actually feed the engine of the system, and the system will be self-sustaining. Now, can good be too good? You know, you can go out and you can have one drink, or you can go out and have 50 drinks, and we know what happens in the morning after the latter. So let's say that that money starts flowing. Now, all of a sudden, what that will create is an inflationary environment. An inflationary environment will create a faster tapering. A faster tapering means a pulling back, and we don't know at that point what could happen to the market. Now, on the other side, you could have the taper happen and the velocity of money still declines, which means the purse strings are tight, no one's going to spend. That would be a problem. So I see one of two things potentially happening in this market. I'll discuss it in a second for 2014, but that leaves us with our last and final leg of our fusion analysis, which is the technicals. What you're looking at here on a technical basis, first of all, it's the S&P 500 index from 1996 to the year 2013. You can see the run in the tech bubble or prior to the tech bubble, and then you can see the channel, which really is the 100-year market theory, and we can go into that, and again, you can read about that and understand what the 100-year market theory is about. But when we look at the bottom, 2009, to where we are today, what you're looking at is a 64-month move. So 64 months. On any business cycle, very rare will you ever find a business cycle that lasts this long. We did a webinar before that I went and discussed the length of time during these periods where how long a business cycle will last, or how many times the market has ever went over 5 years having a positive return. And by the way, it was only 4 in the last 100 years. Now, what we're looking at is on a technical basis, you have a long-term trend and an intermediate-term trend. Those trends right there are very, very crucial. There's actually a secondary trend, which is shorter than the intermediary, which is also very important, but I didn't want to dive into that today. But what we're looking at is as these trends start to increase the way they're increasing, the market becomes what is considered to be parabolic. Now, I'm not going to go into too much detail about it, but what I can tell you, even a correction down to just the intermediate-term trend, you're looking well over 10%. If you have a correction that actually is deep enough to go down to the long-term trend, you could be as much as 35%. So I bring to you this. I say, well, what could potentially happen in the market? I want to, you know, I've been trying to talk fast, and I didn't want to take up too much time, but there's a lot of topic to go over, so I'm going to leave you with a couple things. The first thing I'm going to leave you with is I believe that the market could actually go up another 25% after everything I just said. And the reason that that would happen, if the moon's aligned right and the planets were there and everything seemed accurate, if the Fed stopped tapering, but yet the banks started using their money, spending their money, getting it out into the system, corporations started buying new product, employment picked up, GDP looked great. I mean, those things actually could placate another 25% up move in the market, and it would happen very, very quickly. However, if those planets do not align just right, I also could easily see a 25% downturn in this market, at least a corrective state this year. So it's funny, you know, you talk to a lot of chief strategists such as myself, and you say, well, can you please tell me what's going to happen in 2014? I can tell you this. I don't have a crystal ball, but what I do have is the ability to know what could happen. And we use the technicals, even though they're still in great shape, they're getting very, very extended. So if there is, that's why fusion analysis is so important, because we understand the risks of the market. We understand the underlying foundation. But by using the technicals underneath, we know if we have to pull the plug, we will be tactical. We will pull that plug and get out of that way to ensure that we don't take that drawdown. And what's going to happen is a lot of people are feeding into this system. So I'm going to leave you with this. I have to stop real quick with the presentation, and I'm going to bring you a quick chart that I did before we got up this morning, and I'm going to show you a few things that could be somewhat scary. So what you're staring at now is the S&P 500 from June 2007 to March of 2014. And I took some of the worst times and some of the best times in the market and I overlaid them. So I'll start with this one and I'll bring you up to the 1970s. What this one is I've overlaid on top of you. This right here is the 74 debacle. You can see 1974 right here. And after the 74 debacle, which by the way, if nobody knows this, was the second largest inter-cycle debacle that has been seen in the last 100 years other than the Great Depression. And it came up, had a nice rally as they fed the system in Keynesian economics, and when they stopped feeding the system, you saw a nice drawdown here of just over 20%, and then it vacillated sideways for many, many years before it actually broke out of the long-term channel. And I just wanted to show you some similarities in the difference of the length of time on a recovery based on a Keynesian system of pumping money into the economy. So I'm going to bring you another one, and this one's a little bit more tumultuous. This right here, everybody on the webinar, this is the Great Depression. This right here, I'll pull it up for a second. So you can see started in September of 31, and just so you know, the market didn't bottom until September of 32, but I wanted to show the correlation on the way down as well as on the way up. And you can see the peak trough here at the bottom. I just got to put it in the right spot. And as you can see, this correlation started to increase and length of time, and then this was the next fall down after that, and we went into World War II at that point. You can see this is 37, and then we saw a massive decline. And the last one I'm going to bring up for you is this one. And just so you know, this is pre and post tech bubble. So you can see the similarities of coming down into the trough, same period of time. Then the extension came up and the length of what the extension was, and then these parabolic moves at the end where the market went up and then it began to roll. What I'm going to point out is at the tops, things are very similar where they'll consolidate up at these tops like this, or over here you'll consolidate for a while and then it'll begin to fall. I don't know if we'll actually have another 87 ever on our hands again. You always have to be prepared for it. But I thought it was interesting to be able to bring this up to you and the similarities on some of the greatest runs and then what happened after some of the greatest runs. And again, I'm not placating that the market's going to collapse tomorrow. What I'm saying is that there's too many people that believe there's no risk in the market. Risk is what underlies the market, not what drives price. Let me say that again. Risk is what underlies the market, not what drives price. Risk is what the people don't see. We here at Tesseract believe that risk is the amount that you could potentially lose out of one's pocket, hence why we back everything up with the technicals and use Fusion analysis to make these determinations. So on that note, I think I'm done, and they're probably telling me to get off now because I've been talking too long. So I'm going to go ahead and turn it over to TM Portfolio's Portfolio Manager. Let me go ahead and switch this over, make him a presenter, and he will go ahead and walk you through the portfolios.
All right, we're up and running. Okay. Like I said, I'm going to take about 10 to 15 minutes to go ahead and give you guys an overview of the portfolios and how we've performed over 2013, and just kind of based on a lot of what Kevin said, kind of give you a projection forward of what we see going forward as risks and some just some general overviews of how these portfolios operate. And first of all, I want to say that, being that this is a top-level overview, if you want any more detailed breakdown of the portfolios, you can go to our website. And you can see what we're in right now. You can look at all the positions, look at our the technical performance, the portfolio performance metrics that we look at. So I'm going to keep it top level, but I also want to say too that, speaking to Kevin's point about fusion analysis, it's so important when we decide about our allocation shifts in the portfolios. You can't just look at one thing. You have to put all of it together. And on the technical front, there are a lot of things that look pretty good, but putting the holistic picture together, like you said before, there's some caution out there, and there's some awareness that we are. So I'm going to go ahead and now get into Sage and talk about kind of what this portfolio delivers. So Sage, first of all, it's our sector rotation strategy, and it's focused on reduced volatility growth. And reduced volatility growth is important because you know, in times of when market risk increases, you know, it's our viewpoint that sometimes we need to reduce exposure, and this reduction of exposure leads to smaller drawdowns in those periods, and at the same time, sometimes it also causes us to not quite meet the performance of the benchmark. But again, these are longer-term portfolios, are not meant to be viewed on a one-year time frame. So you have to remember that in a 3 to 5 year period, by paying attention to the risk, by reducing exposure in those periods, we will outperform the benchmark. But on the smaller time frame, you might see the performance lag a little bit. But again, the volatility, like you can see here, standard deviation, basically the whippiness of the portfolio is 6.4% versus 9% of the S&P total return, which is about 2/3 of the volatility. And another thing I want to point out is the max drawdown this year at a period when we had to reduce exposure went down to about 1.5% of a drawdown versus 2.9% in the general market. Okay, another thing I want to point out here is that you're getting in Sage, you're getting what we call an alpha generation, and this is when you adjust the portfolio for on a volatility metric, you're getting an outperformance over the benchmark. And again, that's adjusting for volatility. So there's a 2% outperformance in that metric with an 82% correlation. And there's just some top holdings I'll just briefly go over with you real quick. So we've been in the Vanguard Total Stock Market Index. It's the VTI. It's our general market exposure, the 20%, followed by the Healthcare Select of about 16%, and followed by Banking. You can see there below that is a 10% exposure, and another of our Market General ETF, 10%, and followed by that is Consumer Discretion. And there's more positions in the portfolio. Right now we're about 11. And you can go to our website, like I said, look at our monthly transparency report to see that breakdown if you're interested. Okay, this chart here is a growth chart. The portfolio's only been open for a year. And as you can see, I want to highlight these periods here and in May time frame and in July. And these are periods where the portfolio was exposure was reduced. This was the announcement of the taper back in May, and you can see that our drawdown was a lot less than the drawdown of the market. So that is the intended objective. It's achieving that goal right now, but again, you're seeing that bit of a separation going into year's end. This drawdown analysis here kind of shows you how the portfolio, the drawdown of the value versus the S&P, and you can see that in the entire year, the S&P went all the way down to 5.5%, and we only were right around the 2% area. So again, those are periods of time where we had to reduce exposure, and you can see it in this chart. Here's another presentation of the volatility metrics, the 9% versus the 6.4 I was telling you about earlier. So you're getting that 2/3 of the volatility, and then here's a bar chart kind of highlighting how we did on the month, the quarter, and the year. Okay, next portfolio I want to discuss is Pulse, and this is our tactical long-short ETF, and its purpose, it's designed to capture the majority of these cyclical expansive phases in the market, the 1 to 4 cyclical cycles, and then capitalize also on the downturn bearish phases when recessions occur. So we capitalize on both parts of the move, and you can see that in the year-to-date numbers here. We've been exposing the market. The portfolio itself has been open since 2013. Our data goes all the way back to 2000. But for the year, we're neck and neck with the S&P. I mean, we captured 99% of the market gain, so it doesn't get much better than that. The standard deviation is on par. Like I said, we do. This portfolio captures that gain via Market General ETFs, and so you are going to have a little bit of a higher standard. You're going to have a similar standard deviation to the market because of that. But this next box here that came up, you have less than half the max drawdown since our data goes back to 2000. So you're talking a 20% drawdown versus 51% in the market. And this just highlights when it's time to get out of the way and it's time to, when these cycles shift, we're on the cutting edge of that. We're on the front end of that, and we can shift into those cycles and capitalize on the down movement. And this is reflected in this number here. The other thing I want to point out is high alpha. That is the beauty of this portfolio, is it generates extremely high alpha over the market when you, again, adjust for volatility with 11% correlation. So you're getting 16% outperformance on the market on an annualized basis, adjusted for volatility, with 11% of the correlation. It doesn't get much better than that. And here's just the breakdown of the holdings. Again, I said it was a market general ETF, so it has the QQQ, which is the NASDAQ ETF, and the SPY ETF, which is it tracks the S&P 500, and it's about 50% exposure typically for each position. Okay, and this is just the chart of our backtested data. It goes all the way to 2000, and you can see the just abnormous growth in pulse. And again, when you have these shifts over to the down phase, you can see how it takes off here at this period of time, then reallocates and shifts long again when the market, when our metrics dictate it's time to capitalize on the next cyclical cycle. Here's another drawdown chart I wanted to show you. You can see that in the ranges from 2000 to 2002, when the market had a 50% correction, pulse was in the 20% range. In 2008, again, it stabilized right around this 15%. So it really minimizes those drawdowns and preserves capital. Longer term viewpoint here on the chart down here, we have since model inception. These are annualized numbers. So you've got a 15% annualized return on the model. It's phenomenal. 10 years is 13, 7 years is 16. And so this chart here really highlights the longer term focus of the portfolio. So if you look at it on a 1 year or 2 year basis, you might not see that great outperformance, but you know, with a lot of data, you can really see it shine here. The last portfolio I want to address is BIG, and this is our income and growth strategy. It is it's tactical in the sense that it can hedge during market drawdowns, and it does this via inverse ETFs. And the beauty of that is other bond funds that you might see out there, or income funds. When they think it's time to get out of the way or reduce exposure, a lot of times you see them go into cash. And instead of going just into cash, we actually buy we sell one of the positions, which is typically a market general ETF, and we will buy an inverse ETF. And that not only preserves the capital, but it can sometimes even generate alpha on the way down. And that's not the intent, but if it happens, that's the beauty of using an inverse ETF. You can see on the year to date, we're about flat for the year. Again, this is another longer term portfolio. 5 years at a minimum is of a viewpoint. So you'll see that growth, and I have a chart in a minute that shows you that. But what I really want to point out is the yield. You have a 2.5 times yield of the benchmark. And by staying in these positions and not having to sell out of them when risk elevates, you need to reduce exposure, you can maintain these positions for a long period of time and keep generating that yield and receiving the yield on those positions. So it also reduces turnover and is good for tax reasons, because you can hold positions for a longer period of time. And similar to the last chart.
Can you hear me?
Yeah, Kevin wants to say something.
This is Kevin. Yeah, I would like to address, maybe I missed it, but if you could extrapolate on the yield of Blue Water's income and growth versus the benchmark on tax efficiency.
Oh, okay. Yeah, I have a chart in a second I'll get onto with that. But in fact, I'll just finish this part here, and I'll get to the next slide that talks about that. So again, here's some MPT statistics where you can see the alpha generation of BIG above and beyond the market. So you're getting a 9% annualized return on BIG when you factor out the volatility. And that, again, that's intent, long-term income, but you also want to grow the capital and preserve the capital. Here's our top holdings for BIG. We have a 30% position AMLP. Going to Kevin's question, AMLP is a position that has it's tax efficient in the sense that, well, I won't dive into details here, but it's that position and the municipal bond holding here. This is a muni bond ETF. It's also tax efficient. So you have about 50% roughly of the portfolio that is tax efficient. So when we're talking longer term time frame and you're holding these portfolios for years on end, that is really going to come back in favor to you when it comes tax time. So that's I think what Kevin was pointing out, and I wanted to just hit on that to answer his question. Here's growth of BIG since 2007 was our data inception. Again, the actual portfolio has been live since 2013. But you can see how using the S&P as a secondary benchmark and the Barclays Aggregate Bond Index as a first benchmark, you can see how we really minimize that drawdown from inception, right when the market had its downturn in 2008. We got out of the way, took a little bit of a drawdown, but not much, and preserved the capital. And then when it was time to reallocate, our hedging position was was eliminated, and we were again fully exposed to the market. And you can see longer period of time that great outperformance of the S&P and the primary benchmark. Again, another drawdown chart just to kind of again hit home that point of the preservation of capital and drawdown. So you see we're around the 10 to 15% area. The market went down 54%, I believe was the actual number. So last chart here, just kind of a different way to look at the positions, just a pie chart. And annualized return, I want to emphasize this chart just because I sound like a broken record here, but longer term portfolios, you really see the benefit and the beauty of how these operate in longer term numbers. So you can see a 5-year annualized return is 11%. Since model inception, to 7% return. In the 3 years, a 5.8% return. And there's your tax efficient bubble I wanted to point out. So those two positions, 50% of the portfolio is tax efficient. Okay, so that wraps up the portfolios. Just to kind of bring it all back around and kind of just bring home what Kevin was talking about. The technicals are holding up, and the fundamentals are coming around. But now we have that behavioral shift where the herd mentality is really starting to come into play. And you really have to just be aware of that and just be cautious, especially when it comes to reallocating at these levels, because like he said, if the money doesn't start getting pumped back into the system, what's here to hold it up? But on the flip side, if the money does start getting pumped back into the system and banks start to pump that money and companies start to hire again and this and that and start spending, then we could see easily a continued run higher. So we're really on a precipice right now, and I just wanted to point that out. As far as the portfolios are concerned, we are still fully exposed in all of our portfolios, and particularly Sage, because we have certain technical metrics that tell us when it's time to reduce exposure, and so far we're not seeing that, but we are taking advantage of the move while it lasts. And if it lasts another month, 3 months, great. But one thing, rest assured that if we see that weakening, that deterioration, and then the other fusion analysis metrics start to confirm that, we will reduce exposure and we'll protect that capital so that we will minimize that drawdown. So with that being said, I think I'm going to go ahead and end it here. If there's any questions, I guess type it in the room, and